Viv, when it comes to forecasting commodity prices at the moment, there are so many disparate and moving parts to the equation. So I'm just interested in what's your starting point for formulating a big picture situation. So you've got one that is defined by moderating growth generally, but it's obviously the Chinese dynamic that's more important here. We were just talking about whether or not the 5% growth target for the full year is realistic for China, and you think it might undershoot a little bit.
Yeah, look, when it comes to China's growth, look, for the last 2 years, they've been targeting around 5%, and both times they've hit it. I think this year, we're seriously at risk of not hitting that exact 5%, and we might get slightly under, and it's completely defensible. We know that tariffs have played a big role here, and is that enough for Chinese policymakers to be okay with something that is actually slightly sub 5%? Now, in terms of what is happening in terms of their economy from the first half to the second half, I think that's all very critical in terms of, do they get to 5%? In the first half of this year, they've actually overachieved. But a lot of that overachievement, has come from front-loading exports and increasing industrial output. And that's all been done to get ahead of tariffs.
Yep.
Now, naturally, if you front-loaded anything, you're going to leave a gap in the second half. And that's really where the risk is that you're seeing this slowdown, particularly in the commodity-intensive sectors. And therefore, you're leaning more heavily on consumption to drive China's economy, and it just doesn't seem to be picking up the slack. And because of that, we really have this risk of stimulus coming in. And this is precisely what they did last year and the year before, that around September, October, they announced stimulus, and we think something similar is going to happen this year.
They haven't sort of really been on the front foot, though, preparing the narrative for that. Is there a risk that perhaps they wait a little bit longer and then that has some unwelcome impacts on prices?
Look, it's certainly true that if you looked at where the policy bias has been, it's about consumption. They want to help households. And, you've seen it with, preschool fee waivers and helping more on that side of the equation.
Yeah.
That interest in boosting, say, infrastructure investment or helping the property sector in a very material way, that has not been so much in terms of a detailed conversation. Like, they have certainly talked about it and looked into it, but in terms of something that we can see line of sight that this is certainly what they're going to do from a stimulus point of view, it's tricky. But as we've talked about previously, infrastructure investment is your bang for your buck. If you want to get growth relatively quickly, you try and push infrastructure investment higher, and that can get you your outcomes. But this is kind of that sacrifice of, you can get the short-term blip, right, in terms of that support, but are you sacrificing longer-term growth by doing something like that? And I think that's going to be the conversation. How close to 5% do policymakers want to get to?
Well, to your point, that infrastructure push has had quite a marked impact when it comes to iron ore prices. They've almost been surprisingly strong and seem to be consolidating above $100 per tonne. But your view is that that's going to soften up in the back end of the year.
Yeah, look, our view is very much guided by more the fundamental part of this equation. Is that if we look at what policymakers are trying to do, yes, there are demand headwinds right now. And we can see this with steel mill margins falling, right? So there's clear demand headwinds. If you look at some indicators like the construction index of China's non-manufacturing PMI, last month we were at the lowest level, like since the index began in May 2012, if we exclude the pandemic. So, there are already indicators there that we're like, oh, this is worrying. Now, they've justified that with bad weather, and it has been bad in China. But we really do now question what is the underlying demand going on. And that's kind of why we think stimulus might be there. But whatever the demand kind of momentum is, what really drives iron ore in our view right now is what do they do in terms of steel output cuts? And this has become a very big conversation, because if we go all the way back to 2021, China's steel output has either been flat or contracting. And most of that contraction has been because of reducing industrial overcapacity or reducing greenhouse gas emissions. And because of that narrative, we're calling for a 2% cut this year. And, reduced steel output means reduced iron ore demand, which should then translate through to reduced iron ore prices. And that is why we think we're going to go into that sub $100 a ton mark by the end of the year. We're we're about mid 90s in terms of what our view is. But this market, in terms of how it evolves, on the one side, you have demand. We're saying steel output cuts is the most important, but the third part of the equation, which means that iron ore can't fall too steeply, is what's happening on the iron ore supply side. Like what I think is one of the missed parts of the iron ore market is, ever since we saw the fatal dam collapse all the way back in January 2020, this market has had to absorb very high cost supply in the $80 to $100 a ton mark. So even if we see iron ore prices fall, right, it can't fall too much because you'll price out all this high cost supply. And we estimate that if you want to talk about $90 a ton, you need China's steel output to fall about 6 to 7% annually, and we just don't see that. In terms of playing out, that would be a record going all the way back to 1990. So there's so many things to kind of consider. But if we put it all in perspective, steel demand, steel output, and the iron ore supply curve, the way we're looking at it is mid-90s is a stable point by the end of the year.
Another important factor in lithium pricing, obviously, is what's going on in China, and arguably one of the main factors has been the big lepidite mine there that's been shuttered. The cattle, the owners, I'm terrible at pronouncing these Mandarin names, but you know the one that I'm talking about. So is there a risk that this mine comes back online and then the assumptions that have been made when it comes to lithium prices get thrown out the window?
Yeah, look, in terms of where prices have been, I think the perspective here is, look, prior to this rebound that we've seen since the beginning of July, these prices were down 90% from peaks end of 2022. So we're starting from a very low base, and a base where arguably it was just not sustainable for a lot of industry. Now, this shuttering of a lithium mine is not isolated. If we look at what China has done on the commodity supply side, they are doing a big policy push since the beginning of July has been this anti-involution policy. Now, this policy is just about stopping this intense price competition and removing outdated capacity. In lithium, it has taken the form of removing any supply that they consider is illegal, right? And that's affected, the cattle mine. It's affected, actually lots of production, right? And because of that, we've seen, lithium spodumene and lithium carbonate prices really surge, and led us to believe that, look, we're past the bottom. Just purely on this supply side policy, we're probably past the bottom. But the idea now that we're going to be in this bull run, I'm like, let's moderate the expectations. That's another question. Yeah. And if you look at how this market is evolving, yes, demand has been solid. If you look at EV sales, and any other market would comfortably absorb like this 15 to 20% growth in demand. But such is the latent supply that can come online in this market that it can really absorb this.
It can come on quite quickly as well.
That's right, and this is ex-China. So yes, this policy in China has helped prices lift, but to think that we're in the beginning of a bull run, I would say is just like, let's just wait and see the evidence. But our expectation is, yes, we're up, but it's going to stabilize and wait for the supply response. That's our concern, is if it gets too high, supply can respond.
Now, the other quite captivating aspect of the metals picture at the moment are gold prices. We have seen consistent records being struck in recent weeks. This is a complex picture because it's tied to a couple of things, not least of which is the perception around the fiscal control that governments have both in Europe and the United States. It's been reflected in ultra long interest rates. Is that something that you incorporate into your thesis at the moment?
Look, I would say absolutely. I think gold is one of those commodities right now that is looking past its own, I guess, sphere, and looking at seeing where cracks are appearing in the market. And I think this thematic of US exceptionalism is one that has emerged in April, and one that has reared its head again. Right now, the most recent drivers, Fed independence. We have seen President Trump get involved in how the Fed runs its business with Governor Lisa Cook. And the second part of that is, what is the legality of the tariffs? Are we, like, there's volatility now in terms of where does that policy go based on what decisions do we see from the Supreme Court? Now, all of this leads.
So what you're saying there is that if the Supreme Court in the United States rules that the tariffs are in fact unconstitutional, then all of that has to be unwound. The benefit of collecting the tariffs for the fiscal position gets wiped out, and you're just dealing with a big free spending government.
Exactly. And it's like, okay, how do you make up for this? This is a massive step change, and it adds a massive amount of volatility to policy decision making. But like fiscal budgets just get blown up, right? And this kind of concern in terms of the degrees of outcomes now possible, I think gold has latched onto that and been like, this is very unpredictable, and where US is going, is US really the place where we should have safe haven demand centered? Because if you go back to the global financial crisis, 2008, 2009, and you then go to, even the pandemic, you saw a clear batting order of preference for safe haven, which was, US dollar, US bonds, gold.
Yeah.
This was how the market has viewed gold. It's not in the realm of say US dollar. Just as a main example, we saw that flip in April.
Yeah.
Gold was preferred over the US dollar, and we have seen similar conversations play out, or outcomes play out, in the last kind of 2 weeks. And so this narrative of structural safe haven demand based on concerns about the US being the safe haven demand component, I think that's come under question, and that is always going to be very bullish for gold. And last time we saw gold gap in April to take a $300 an ounce premium, we're almost seeing something similar. And this is why we think 3650, potentially even 3700 is now on the table for fourth quarter as an average if we see these premiums kept. And that's very much looking like the view right now.
We've only spoken about the US side of things. The French government is going to endure a confidence vote this week, and that puts their budget on a very precarious footing. The UK is in a similar position as well. They've got an upcoming budget that's going to really put their feet to the fire. To what extent do you see those outcomes being important to the gold price, or is it mainly what's going on with US tariffs at the moment?
Look, I would say it's probably more US centric. Look, I think adding geopolitical risks are all there, but I would say that's more of a secondary factor. It's not, for me, the primary. But like if you want to add fuel to this fire of safe haven demand, just price in more rate cuts and poor US labor data, and that's exactly what's given fuel to the story, which was already burning from safe haven demand. And so, this part of the equation, we just saw data come out last Friday, a poor labor market in the US, pricing in more rate cuts. I think next April, in just a week, next June actually, we're now pricing in, say, 120 to 125 basis point of cuts in the US now. A week prior, it was, only like 105 to 110. So we're already seeing markets respond, and that's bullish for gold, because then gold looks even more attractive to interest-bearing securities in the US.
So Viv, the other vexing question at the moment is what's going to happen with oil prices. So we have just come out of a weekend where OPEC has decided to just add a very marginal bit of supply to their output picture, but you've written about the fact that that is just the beginning of bringing forward a much larger tranche of production that was initially slated for the end of next year. So what gives OPEC the confidence that they could really deliver this volume of supply into a market where you've got a global economy that's moderating?
Yeah, look, it's an excellent question. And I think the strategy of OPEC Plus this year has very much been about claiming market share. Now, we've seen this since April. So April to September, they've added about 2.5% of global demand. They've added back relatively quickly and much faster than anyone had anticipated. And as you said, we're now into the next tranche. Now, in our view, the current market conditions, you can see the rationale behind OPEC Plus. For one, global oil stockpiles, they are nowhere near levels where you'd be worried. They're actually on track with historical averages. And so because there's no oversupply flag being raised, you can see OPEC Plus is like, well, you tell me where the oversupply is because we don't see it, and so we're adding. And from that perspective, it makes sense. The other part, diesel refining margins are still elevated. And if you look at what OPEC Plus produces, their type of crude oil actually fits more into producing diesel. So they have complete justification right now to actually pump oil into the market. The risk that they run is actually more fighting the forecasters, like International Energy Agency, US Energy Information Administration. The forecast is that fourth quarter of this year and first quarter of next year, we're going to see a deep oversupply in the market. And this is where prices can potentially fall. Now, we're in that camp, but we think it's going to move into that $60 to $65 a barrel range for Brent. But this is really where the pressure is on. Are the forecasters right or OPEC Plus right? And that tension is right now in the market. And surprise, surprise, prices right now are about 65. Just on the cusp of where both sit in terms of it's too high, so let's see whether we can bring it into, in our view, the price range that OPEC Plus are now targeting. Now, OPEC Plus strategy in terms of why they're targeting that level is really critical, because they are looking to stop non-OPEC Plus growth from being too strong and eclipsing global oil demand in coming years. So that's why they have probably lowered their oil price target, which is very unofficial, probably from 70 last year to the low 60s in our view. And that's really, I think, the growing narrative, because they don't want to keep prices too high and then keep ceding market share in future years. So this strategy makes sense, and they're really pushing it. But fourth quarter and first quarter next year, I think everyone is going to watch that global oil stockpile picture, and that's going to determine where we fall in terms of oil prices.
So how much of a swing factor, taking those forecasts into consideration, is the impact of Russian supply at the moment? Because we hear so much about the contribution that they make to meeting Chinese and Indian demand. Does that make the forecasting picture all that more murkier?
Yeah, look, in terms of the key upside risk, it'll be, does Russian supply get sidelined? And what is very clear from since the Ukraine war started is Russia's supply has proven to be very resilient, right? Like, we have seen sanction after sanction thrown against Russian oil. I think the Biden administration, before they left, really targeted their logistics and shipping.
Yep.
And despite all of that, they've managed to keep their oil supply very strong. And I think that has been, now part or entrenched reality that, let's wait for the evidence of these sanctions actually hurting Russian oil. And the connection that we've seen with India, being okay to buy Russian oil, it means that the risk of disruption is even lower, right? So India will wear the higher sanctions or the higher tariffs from the US because it looks like they're still going to keep purchasing Russian oil, and that minimizes the risk of disruption. So, Russia and the Middle East are clear upside risks. If we see anything happen from that supply side, but so far it's been a worry, but it hasn't been anything in terms of actual disruption. And I think that's been one of the reasons why the markets are not fearing it, because how long can you keep saying, this is the boy who cried wolf story?
Yeah.
The market is waiting for clear evidence of it, and so far that's not happened.
What sort of signals are you getting from the energy markets about the trajectory for global growth? Because there seems like there's a catastrophist note in some of the demand forecasts for energy. If you were to correlate that with where we end up, where global GDP is concerned, it might be a little bit lower than where we're expecting growth to be in the next 12 months.
Look, oil growth and GDP growth, they've been connected, obviously, because of how people consume oil. But what is changing that connection is the fact that we're seeing that movement in the transport sector from oil to electric vehicles. And so China is, for me, the real canary in the coal mine. It's a real disconnect now between their GDP and their oil consumption growth. And this is something that we could see play out in other economies as they shift towards EVs. But this idea of slowing global oil demand growth, it is very much linked to the transition.
Yeah.
As opposed to, say, global GDP, right? And I think as that narrative takes hold, and we definitely saw that last year, that global oil demand growth was quite anemic. This is, for me, something to keep watching is are we going to see, global oil demand stay sub 1%, in coming years? And, like if you look at what International Energy Agency is saying, is we're going to get peak demand by the end of this decade. So I think that's probably where all the risks are on the demand side. But yes, it is delinking from GDP growth.
There's never enough time to talk about these things, but really grateful for the conversation today.
Thank you.
And thanks for joining us for this discussion about the future of commodity prices.